Profits at Chrysler also revving higher. Net income last quarter rose 16%, helped by strong sales in the U.S., especially for pickups and Jeeps. This marks the 8th straight quarterly profit for the bailed-out automaker, which is now majority owned by Italy's Fiat. And joining us now to talk more about the U.S. auto industry is John Casesa. He is managing director at Guggenheim Securities. John, welcome back. Good to have you on Nightly Business Report. I guess there is kind of a drumbeat that adds up to this. American cars are back. Do you agree?
I do agree. I mean, the market's back and Americans are buying cars, but the U.S. companies are competitive, the most competitive they've been in probably 40 years. I mean, back to the first oil crisis.
And can that continue, John? Because, you know, there's some talk that U.S. growth may slow a little bit if the, excuse me, if the Fed starts raising interest rates. Does that change the scenario or not?
Well, I think as it relates to the whole market, the average age of a car in the United States is 11 years. Almost 90% of Americans get to work by car. So the car is a necessity. The fleet is old. It has to be replaced. So unless rates skyrocket, I think auto sales will continue to be healthy. As it relates to the competitiveness of the U.S. companies, you know, even through the crisis, they had been getting their act together at productivity, quality, design, and styling. And once they got through the restructuring and their balance sheets were better, they were able to plow money back into product. So Chrysler's selling a lot of the new Dodge Ram. Ford's selling a spectacular new Ford Fusion. GM's Chevy Impala got almost the highest rating ever for a sedan in Consumer Reports. That money spent over time is starting to pay off today, and they're competitive now with the Japanese.
What are you seeing in terms of market share of the U.S. automakers in the U.S.? How has it changed, if at all? Is the needle actually moving?
Well, it's moving a little bit. This year, they have about 46% of the market. That's up from a low of 44% 2 years ago. But to put that in context, 30 years ago, in 1983, they had 73% of the market. So there's been a very long slide, and in the last few years, that chart's turned up. And I would say now that share is up in 2010, in 2011, 2012, you know, there's really some sustainable momentum here. It's not a fluke.
There's a lot of talk that Chrysler will go public, and perhaps the market conditions that you described would make it a very conducive time for them to do so.
Well, I think it's right. I mean, these auto companies, it's very hard to be private. You need a lot of capital, so the public markets make sense. Auto sales in the U.S. will probably rise for at least a few more years. And Chrysler's got a lot of new product coming, so I think there'll be good investor appetite for the IPO when it comes.
What have they done right, apart from styling and improved quality?
Well, as it relates to all of the big three, you know, they have completely reconfigured their plants. They've changed their relationship with labor. They've streamlined the product development process. So instead of taking 6 years to do a car, they can do it in 3 years like the Japanese. So they're more in sync with the market when the cars come. And of course, they've also spent a lot of money on powertrain. These cars get more fuel economy, even though they're just as big as they were 5 years ago.
You know, the electric car movement does not seem to have gained as much traction in certain parts of the country that a lot of people thought it would. Do you agree or not?
Well, it's a fact. Those cars are not selling that well. And I think there are two things that will get them to sell well. Either gas prices need to go up a lot, and or battery prices need to come down a lot. So, you know, in a conventional car, the engine's $5,000. In an electric car, you take that out and replace it with $15,000 of batteries. That's a big premium.
John Casesa, thank you very much. John is Senior Managing Director at Guggenheim Securities.